Before we start this video, do like and subscribe to our channel and not miss on any updates.
Friends, let's now start with the next topic, that is integrated reporting. Now, which subject are we learning? We are learning financial reporting. When we say financial reporting, what comes to your mind? Something like P&L, balance sheet, financial performance, statement of financial position, statement of cash flows. All of these are related to financial reporting. Now, for anyone who has invested money in a company, money matters, right? I have given money to the company. I want the company to make profits. I want the company to grow. I want the company to pay me back in terms of dividend. I want my capital appreciation. So, monetary angle is very important. But then, is money the only important parameter for someone to evaluate a company, right? Can we just say that just because the company is making profits, it is a good company or it is a bad company? For example, if a company is making profits by adopting unfair means, then in that case, is it good for the society or is it bad for the society? Is it good for the investor community or is it bad for the investor community? Just by looking at a financial report, you will not be able to understand on a wholesome basis as to how the company is performing. Now, all of you would have learned it as a part of your costing, financial management, that there are something where you have short-term profit orientation. That is, you want profits immediately. But in the long term, the company may not be able to create profits or company may not be able to generate profits. Just to give you a simple example from a day-to-day life, I can defer the repairs and maintenance of my car and I can save money there. So short term, there is a higher profit. But in the long term, the car will suffer, the machine will suffer. So in the long term, I may not be able to generate profits. I can get more profits by selling poor quality products. But then over a long term, customer will stop coming to me. So in the future, I may not be able to make profits. My brand name will be at stake, right? So just by looking at a financial performance, just by saying that profit has gone up by 50%, 70%, 30%, it does not indicate that the company as a whole is performing well on different parameters. Yes, financial performance is good. How is the non-financial performance? Now, of late what has happened is regulators across the globe, they have realized that only financial reporting is not important. We also need to take care of the non-financial aspects. Non-financial aspects, these have to be communicated to the various stakeholders, investors, government, society, employees. Everybody must be aware of how the company is creating value over short term, medium term and long term. And that is where the concept of integrated reporting comes into picture. Right. Now, if I take up the annual report of Tata Motors, it says 77th integrated annual report. So, it is not only an annual financial report, it is an integrated report. And in India, the companies have been asked to adopt integrated reporting on a voluntary basis. Initially, this will be voluntary. Over a period of time, they may be made mandatory. Now, when we talk about integrated reporting, we are not only reporting the financial part, we are also talking about various non-financial aspects. We are talking about strategy, we are talking about governance, we are talking about value creation, we are talking about various different other aspects apart from financial reporting. So, finance is there. We are not saying don't report financial part. Finance is there. Apart from finance, we have other reporting aspects as well. And of late, a lot of thing has come up also in the area of ESG, environmental, social and governance, right? So, for example, a company which manufactures tobacco products, they see it as negative to the society because it causes health hazards, right? So a lot of these things have also started coming up. ESG companies which are not friendly towards the society, not because they are doing harm, but because they are creating products which are harming the society, right? So these things have started coming up. And all of this is focused towards something called as sustainable development. Don't only look at the short term, look at the overall long term picture. And integrated reporting, what we are talking about, focuses on the long term value creation, how the companies create value over short term, medium term and long term, right? So that is what we will be discussing. So I'll take you through few reports, few components of this integrated annual report before we actually jump into the chapter. If I directly take you to the chapter, you will sleep off in the lecture because theoretically it might sound too boring. Now, if you look at this part of the annual report, it talks about capitals, right? Now, when we say capital, generally what comes to our mind, we think about money, we think about equity share capital, we talk about financial capital. But then, when we are doing an integrated reporting, we are not only looking at the financial capital, but we are looking at these 6 capital as per the integrated reporting framework, right? We'll come to it in detail subsequently, but then just to give you a perspective. So, first one is financial capital. What is financial capital comprising of? It includes the funds that have been used to manufacture products and offer services. So financial capital is the money, the equity, the debt, the other sources of funds which have been used to manufacture products and offer services. That is the financial capital. Then manufactured capital. What is manufactured capital? It is the products we create within our own operations and the supporting infrastructure that enables it. So basically manufactured capital is the final output, the inventory, that's an asset, and the infrastructure that enables it, the plant and machinery, all these assets which help in manufacturing the product, which creates the final output, that is the manufactured capital. So infrastructure and the final product. Then intellectual capital. Now what is this intellectual capital? Intellectual capital is something to do with your intellectual ability, the organization's intellectual ability. It is our ability to leverage organizational knowledge based intangibles such as intellectual property and build our knowledge capital to open up new frontiers. So basically some know-how, some patent, something that they have researched, right? The design part of it, the intangible assets, all of that is intellectual capital. And in today's era, especially when we talk about a lot of service companies, startups, fintechs and all of that, this intellectual capital, the thinking capital part of it is very, very important. Then human capital. Now what is human capital? This talks about human resource. It includes the competencies, capabilities, experience and motivation of our people to innovate and implement our organization's strategy. Now, we have learned as a part of strategic management also that there is a strategy for an organization and you need human resources, you need employees to implement them. And this forms a very important pillar of any organization. Without employees, how much ever artificial intelligence you talk about, without employees, the organizations will not be able to run, right? Then social and relationship capital. Now social relationship capital is basically how the company interacts with its society, right? Like we have society, companies also have society, the stakeholders, the society at large, the area in which they operate, all of that constitutes this social and relationship capital. So it includes the institutions like banking institutions, all of that, communities, stakeholders and our interaction, collaboration with them to enhance community well-being. So something to be done for the society. And lastly, the natural capital, the environment part of it, which is the renewable and non-renewable environmental resources that provide goods and services that support our business. So natural capital is basically to manufacture car, you may need steel, right? You may need steel. For steel, you need iron. For iron, you need iron ores. Iron ores come from where? It comes from natural sources, right? So, what are the renewable and non-renewable environmental sources that provide goods and services that support our business? Maybe something like a fuel. Fuel also comes from natural sources. Water, right? All of these are used by the company to manufacture products and offer services to the customers. So, these are 6 capitals about which the entity or the reporting entity is expected to talk about and say not only the financial capital part of it, focus on remaining 5 capital pillars as well. Now when we talk about integrated reporting, what a company needs to report is how do they create value? When we say value, what is the end value created by using these capitals? By using these capitals, that is what the entity tries to explain by using the integrated reporting framework. So now here if you see the value creation model, how our business model creates value. So how does the business model create value? By using those capitals, the inputs that we spoke about to achieve the vision. They have mentioned their vision, to be the most aspirational Indian auto brand, consistently winning by doing so many things. These all keep on changing, right? But if you look at the inputs, the capital, financial capital. So financial capital is what? Financial resources. So that is your shareholders fund, bonds, banks and the financial market. And then you can see the disclosure, 44,561 crores of equity capital, then 24,148 crore investment spending and so much of net automotive debt. So that disclosure is there. Then manufactured capital, there they are talking about the manufacturing facilities, R&D, and Tata Motors manufacturing facilities, JLR manufacturing facilities and all of that. Then intellectual capital, that is something to do with your intellectual properties, design applications and patent applications. Then human capital, how many employees? 52,351 total employees, 25,000 permanent, 26,000 temporary, employees in research and department, then management cadre employees, non-management staff and contractual staff, right? All of that is there. Then social and relationship capital, amount spent on CSR and 28,000 hours volunteered by employees. So they are saying, okay, this is how we are contributing back to the society. And then As a part of natural capital, how much of natural resources and all has been used, electricity, power, and water and all of that, that also they have disclosed, right? And then they also talk about the using this 6 capital, having all of this customer service network, global sales network, financial services, logistic, manufacturing, design and all of that, and what is the final value created, output. So basically if you see inputs, using that inputs through their value chain, what is the output? So if you see the output, the consolidated revenue, financial output, right? Then intellectual property related outcomes, then something related to the workforce, then CSR initiative, and how much is the carbon emission and all of that. Okay, so I'll not get into too much of details, but basically, nutshell they are trying to present, we are taking some inputs, using our value chain, we are generating some outputs. How are we contributing to the society? How are we trying to safeguard environment? How are we creating value? All of that is what is being disclosed as a part of this integrated reporting. As a part of the report, they would also talk about various stakeholders, what are the issues, what are the challenges, what are the strategy and all of that, right? Then what are the priorities? How do they evaluate risk? How do they manage risk, right? A lot of details are given as a part of the management discussion analysis, as a part of the integrated annual report. Then they also talk about various aspects of risk management like supply chain disruption, pandemic when it happened, what was the issue, then how do they position their brand, right? Issues with climate change, human capital, right? So these are the capitals, and for connected to these capitals, what are the various risks that they are facing, that is also disclosed. Now, as far as the reporting is concerned, the integrated reporting is concerned, they say the integrated report has been prepared as per principles and guidance provided by International Integrated Reporting Councils, that is IR framework. This is what we will be understanding. What is the framework for reporting, right? And it is also in with respect to in accordance with the Global Reporting Initiative standards, right? So that is the framework they have been using. The reason why I showed you this earlier is for you to understand how is it actually reported. See, I can just take the book and explain you in theory, but then you will not be able to correlate as to what actually happens in case when a integrated reporting is done, right? So now, having understood this background, let us understand the integrated reporting framework and what are the capitals in detail once again, and what types of integrated reporting is done, what kind of explanations are given. All of those things we will understand. Now, we have understood the broad background of integrated reporting. The overall idea is that only financial reporting does not suffice. So we need to report about various different inputs, the value creation process, and what is the output, and how each of these capitals that we have broadly understood, how are they utilized, and what is the company doing to create value over the short term, medium term, and the long term, right? Now, as far as integrated reporting is concerned, the International Integrated Reporting Council, right, that has been set up, and the idea is globally there has to be a standard framework, there has to be a unified framework for providing integrated reporting, right? So if each company start reporting in their own way, then again it doesn't serve the purpose. So at a global level, we have this International Integrated Reporting Council, which has given us the IR framework. Now this IIRC, it comprises of the regulators, the standard setting bodies, let's say the accounting bodies that are involved, NGOs, investors, companies, right? All of them come together and then they have formed this particular council which provides the framework for integrated reporting, which we will in short refer to as the IR framework. Let's now understand what is the meaning of integrated report. An integrated report is a concise communication. So you don't have to write pages and pages. You don't need to give too much of information. It has to be a concise communication about the organization's strategy. What is the strategy of the organization? Governance. How are governance standards? How do they take care of corporate governance? Performance. So how have they performed both on financial and non-financial parameters? And prospects. What are the opportunities in the future? What are the prospects in the future? So strategy, governance, performance, and prospect. Strategy, governance, performance, and prospects. These four things, about these four things, the organization communicates, right? So when they communicate about this, in what context? In the context of its external environment. So if you look at the company and its external environment, within that, what is the SGPP? Strategy, governance, performance, prospect, right? That is communicated in a concise manner. Then you also communicate how it leads to the creation, preservation, or erosion of value over short, medium, and long term. So basically the focus is on value. How is value created first? Or if the value is already created, how do you want to preserve it? Or is there a chance that it would be eroded? So creation, preservation and erosion of values over a period of time, that is the short term, medium term, long term. So it is not only focused on just net profit, it is focused on much more wider thing, that is value. You have learned about concept called economic value added. So here also we are talking about the value creation. How much value does the company create and what are the capitals it uses, what are the outputs, and all of that is reported as a part of integrated reporting. Now, who will use this integrated reporting, or for whom it is useful? It is useful to all the stakeholders, the employees, the government, the regulators, the shareholders, right, the investors that is, then the creditors, the local community at large. All of these would be benefited with this integrated reporting. Now, let's understand the capital, which are basically the inputs that go into any organization, which helps the organization create value. We've already seen broadly as a part of the integrated report what are the 6 capitals. We'll be talking about these in more detail, trying to understand what each of these capital represent. And please remember, capital keeps on moving. Let's say you have money. That money you have used to buy an asset, right? So that money goes out and a manufactured capital comes in, right? So that is how you have to understand that capital keeps on flowing. It may increase, it may decrease. It will help us to create value. And as per the framework, these are the 6 capitals. There is no hard and fast classification, but broadly this is a framework within which the capital is divided, right? So coming to the first one, that is the financial capital. Financial means money. So financial capital means the pool of funds available to an organization for use in the production of goods or provision of services obtained through financing such as debt, equity or grants. It can be debt, loan, equity, owner's money, grant, government giving some grant or some other company giving some grant, or generated through operations or investment. So you will get money by way of capital contribution, you will get money by way of grant, and there could also be money that is generated through operations or investments. Basically, the surplus that is generated by way of profit, by way of return on investment, all of that comprises the financial capital. Then second one is manufactured capital. Now the term manufactured capital represents that it is manufactured, it is not natural. If I am using water, it is not manufactured capital, right? So manufactured capital represents manufactured physical objects as distinct from natural physical objects. So we are talking about objects, assets which are manufactured, that are available to an organization for use in the production of goods or provision of services, including buildings, equipments, infrastructure. So whatever is manufactured, that is available to the entity for manufacturing goods, services, including your capital assets and all of that, is considered to be manufactured capital. So land is not a manufactured capital, building is a manufactured capital, right? Then the next one is intellectual capital. What is intellectual capital? Intellectual capital is organizational knowledge based intangible. So basically intangible assets that represents knowledge, your patents, your copyrights, your R&D, production formulae, all of that is your intangibles. Intellectual property such as patent, copyrights, software rights and licenses, organizational capital such as tacit knowledge, system, procedures and protocol. So over a period of time, the organization would have accumulated knowledge, like for example in our company also. So just to give you a reference, even in our case, we have a process which has evolved over years of time. We have improvised the teaching methodology, we have improvised the animation methodology, we have figured out what the students want, what is needed for examination success. All of that forms part of the intellectual capital. Now here when we say tacit capital, it is implied, it is not expressly stated somewhere, it is implied. Then human capital. Human capital talks about the human resource, that is people's competencies, what are the skill set they have, their capabilities, their experience and their motivation to innovate. So basically how motivated is the human resource, how experienced is the human resource, how knowledgeable is the human resource, what are the capabilities they have, and their alignment with and support for an organization governance framework, risk management approach and ethical values. So one is you have talented pool, you have experienced pool, you have capable pool of employees and they are in alignment. Alignment means they are thinking the way the organization is thinking. So they are in alignment with the organization values, organization systems, organizational governance framework, organizational risk management approach. All of that they are in alignment with. Otherwise it becomes very difficult. For example, the organization is a highly ethical organization, but the employee is not ethical. Then that will lead to destruction in value rather than creation of value. The ability to understand, develop and implement an organizational strategy. So here what we mean is, can the employees understand the organization strategy? Can the employees implement the organization strategy? Can they improve it? That is what it means. Then loyalties and motivation for improving processes, goods and services, including their ability to lead, manage and collaborate. So are they loyal? Are they motivated? Can they improve the process? Can they improve the goods and services being offered? Right, then can they lead a team? Can they manage a team? Can they collaborate with other teams? And that is how the organization functions. Human beings are building blocks of an organization. You need someone to lead the teams who are working in an organization. For example, if you look at companies like TCS, Infosys and all, where lakhs of employees are employed, you need someone to manage the team. You need someone to lead the team. Do you have experienced staff who can manage the team, who can lead the team? Right. Then social and relationship capital, the institution and the relationship within and between communities, group of stakeholders and other networks, and the ability to share information to enhance individual and collective well-being. So basically the institutions and the relationship, the institutions like maybe your bankers, maybe your suppliers, maybe the government, these are the institutions. What is the relationship with the institution and other group of stakeholders, and the ability to share information to enhance individual and collective well-being. So here we are talking about the company, the institutions, the communities, the other stakeholders, and how are the information shared, how are the information exchanged, so that there is an overall well-being. Social and relationship capital includes shared norms and common values and behaviors. So basically what are the norms? Norms are basically the ways to do things, the principles to do things. How are they shared? Then it includes key stakeholder relationship. What are our key stakeholder relationship? Maybe the investors, maybe the bankers, government, society, suppliers, customers. What are the key stakeholder relationship? And the trust and willingness to engage. So basically the trust and engagement. Engagement means basically sharing of information, passing of products and services, right? So let's say you interact with a company, you are engaging with the company, right? So what is the key stakeholder relationship, and what is the trust and willingness to engage that an organization has developed and strives to build and protect with external stakeholders? So the other part may sound slightly complex. What it basically means is, say Indigolearn is a company, right? Indigolearn has multiple stakeholders. Students are one of the stakeholders. Now, how does the company engage with the students? That is one. How does the company build trust? And how does it continue to maintain that trust? We have built some trust with you. That's why you are watching these classes, right? Now, how do we maintain that trust? That is very important. How do we continue to engage with the students? That is very important. So, that is the meaning of trust and willingness to engage. Are we willing to engage with the students? Are we willing to improve the lives of the students? That is what we are talking about. Then intangible associated with brand and reputation that an organization has developed. So basically a brand, a perception that the company has built in the given society, how will it continue to develop that particular brand, and an organization's social license to operate. Now what is the meaning of social license? Basically society's acceptance of a particular company. Say for example, if there is a company, that company has set up a plant, and because of that plant, the water bodies near the plant, the water bodies in the society, they have been damaged. Now, when that happens, there will be a lot of protest from the society. They will not allow companies to operate, right? You would have seen protest against various plants, various companies which want to set up plants at particular places. There is a lot of protest from the locals, from the villages around, because they believe that environment will be damaged, they are taking away our land. Like this, there will be a lot of protest. And when there is a protest like this, then the company may not be able to operate. So that is what is the meaning of social license to operate. If socially it is not acceptable, it becomes difficult for the company to operate, right? Then lastly, the natural capital, which is the renewable and non-renewable environmental resources and processes that provide goods or services that support the past, current or future prosperity of the organization. So whatever comes from the environment which is not manufactured, renewable as well as non-renewable, that forms part of your natural capital. It includes air, water, land, minerals and forest, biodiversity and ecosystem health, right? So basically these are the 6 capitals: financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital and natural capital. These are the 6 capitals, and you must be able to explain what each of these capital mean. Now, it is not necessary that all these capitals are applicable to all the companies. In some cases, all capitals may be applicable to a single company. Now, to understand how these capitals are used to create value, to generate output, we need to refer to the IIRC framework, right? Now, the framework talks about 6 capital: financial, manufactured, intellectual, human, social, relationship and natural. All of these are linked to one another, right? Now, these are the inputs which are used by entities, which are used by organizations. They are used in the context of the external environment. There could be opportunities, there could be risk, there are processes involved, right? There is a value creation process. All of that interact, you use these capitals, you have a defined strategy, you see some opportunities, you use these capitals, you have intellectual capitals, you have your process, you have the business model. Using all of that, you generate the outputs or the outcomes for each of these category, right? Again, financial, manufactured, intellectual, human, social, relationship and natural. So you create value, you try to preserve value over a period of time, and this is a continuous process, right? Now, if you see this again, going back to the annual report or the integrated annual report, how value is created, these are the inputs, various capitals are the inputs. These are put through the value chain. These are put through the value chain of, of whatever is the value chain they use to create the final output. These are to be seen in the context of the vision, right? And then what is the output and what is the outcome? So output is how much of revenue is generated, how much is added in terms of manufactured capital and all of that. And what is the outcome? Basically the sustainable development goals which are impacted, right? So here decent work and economic growth, industry innovation, okay, then climate action, responsible consumption and production, then industry innovation and infrastructure, then good health and well-being, gender equality, decent work and economic growth, reduced inequalities, then zero hunger means working towards reduction of hunger, then quality education, reduce inequalities, sustainable cities, partnerships, life on land. So these are all the outcomes. So finally, the outcomes which add value, finally the outcomes which are achieved, which help in sustainable development. So coming back to the framework given by IRC, again, inputs: financial, manufactured, intellectual, human, social, relationship and natural. Then there is an external environment, there is purpose, there is mission, there is vision, there are opportunities, there is governance, right? Then there is this business model, what are the activities which creates outputs, and then what are the outcomes, positive and negative over short term, medium term, long term in respect of each of these capital, right? That is how you have to understand this overall framework. Now that we have understood the human capital, how they are used as inputs, how they interact with the strategy, the business model, the business activities, and in the overall governance framework, and how do they generate output and outcomes, let's move on to the next part that talks about the salient features of the integrated reporting framework, right? There is a framework given for integrated reporting. What are the features of that? The first feature is that it is a principle based approach and not a rule based approach. That means it gives the broader principles. It tells us that you have to disclose about human capitals, you have to disclose about the outcomes and all of that. But then what are the specific parameters? How do you measure those outcomes? What are the formulas to be used? All of those rules, all of those formulae are not given by the framework. Now it is up to the company, up to the reporting enterprise as to how do they report the various capitals, the inputs, the process and the output in their integrated report. So it will not tell us that you have to use economic value added formula. It is up to the entity to use the various parameters. Now we saw in the case of Tata Motors, they talked about number of units manufactured, the revenue, right, number of percentage of employees, number of hours spent and all of that. So that is the metric they have used. Is it defined somewhere that you have to use only that metric? It is not defined anywhere. It is up to the entity whether they want to use that metric or any other metric which gives the best representation of the reporting framework. The next feature is that it is made for private companies or for-profit companies, because when you talk about for-profit company, the first thing comes to your mind is finance, right? Now apart from finance, what are they doing in other areas? That also needs to be reported. So it is primarily targeted for these private companies or for-profit companies. Why is it not for public sector or government companies or non-profit organization? See, when you look at a non-profit organization, they are not focused on profit. They are focused on other activities like service, upliftment of poor people, providing education, health and all of that. So there the objective is not profit. When the objective is not profit, then these things would automatically be taken care of. Similarly with respect to public sector. Public sector is not only profit driven, but it has a lot of social cause as well, right? So the key thing is the framework is made for private companies or for profit companies. Yes, with suitable changes, suitable adaptations, you can also use it for public sector or not for profit organizations as well. Then the third feature is quantitative as well as qualitative information. So some information may be quantitative, some information may be qualitative. A combination of these two, a quantitative as well as qualitative information must be presented so as to demonstrate how value is being created. The framework does not say that you have to use these quantitative metrics. The framework does not say you have to talk about these qualitative features, but there has to be a combination of quantitative. Quantitative means which can be measured, like net profit, number of employees, number of units of production, units of energy consumed. That is a quantitative metric. Apart from that, qualitative metric, let's say provision of education, upliftment of some sections of the society, right? What is the company doing to improve the process? How is the company managing risk? All of that is qualitative information. The next feature is it has to be an identifiable communication, meaning to say when the company puts out this communication, the stakeholders must be able to identify that yes, this is a part or this is an integrated reporting, right? Now it can be given as a separate report. It can be given as a part of annual report like we saw in the case of Tata Motors. It does not prescribe that how the reporting has to be done, but when you are making this report, it has to be identifiable. It must not be confused with other report. That is the first thing. Second thing is it is expected to be summarized and concise. Okay, you don't need to give way too much of details such that the reader gets bored, right? So it has to be precise and concise, and it has to be identifiable. You must be able to identify that yes, this is the integrated report. The next feature is that it must have financial as well as non-financial items. So one was quantitative and qualitative. Quantitative means quantified. Qualitative means more of descriptive, like your risk management strategy, the business process, the business process, the opportunities and all of that. Now here when we are talking about financial and non-financial, financial items are those directly related to the financial reporting, like your revenue, net worth and all of that. Non-financial items are other than financial items. For example, number of employees, number of units produced and all of that. So it must have both financial items as well as non-financial items. And the last feature is it must explain about value creation for organization as well as for others. So for organization, what is the value created that you will be explaining or that you may be reporting. For others, what is the value created that must also be explained. So if you reflect back to the Tata Motors report, there was a lot of discussion about value created for the society, outcome for the society, number of hours of corporate social responsibilities, reducing inequalities, all of that. All of that is about the value created for others. And how much is the value created for organization? Both of these have to be disclosed, right? Now, when we talk about value creation, these basically are seen with reference to changes in capital. How much has financial capital gone up? How much has the intellectual capital improved? How much has the human capital improved? There can be plus and minus. So whether value is being created or value is being preserved or value is being destroyed, that has to be communicated, right? So to summarize, what are the salient features? The first one is that it is principle based, not rule based. Second, it is for private sector and profit making entities. Third, it must have qualitative as well as quantitative information. Fourth, it must be identifiable communication. Fifth, it must have financial as well as non-financial information. And sixth, it must talk about values which is created for the organization and for other stakeholders. Let's now have a look at the guiding principles for preparation of this integrated reporting, right? So these are basically the principles which tell us what elements to be included and how the report should be presented. The first of that is strategic focus and future orientation. So when an entity or when a company prepares this integrated report, there must be a focus on strategy. What is the company's overall strategy? What are the opportunities? What are the threats? What is the company doing to improve its strategy in the future? What is the company doing to gather, let us say, a larger market share? What is its long-term vision? How does it want to approach in the market, right? All of those things is a part of your strategic focus and also future orientation. Now, one thing that you have to keep in mind here is financial reporting is historic orientation. Transactions happen, those transactions are presented as financial reporting. Now what has happened has happened. What about the future? What is the company looking at? What is the direction for the future? For example, if you look at, let us say, the automobile industry, there is a lot of talk around electric vehicles. Now how does a particular company want to take advantage of this new market that has come up, right? And in telecom we talk about 4G, 5G, sometimes we'll have 6G, 7G, right? how does the company want to improvise on that? And then there is also a lot of talk around artificial intelligence and related stuff. So how does that impact the company? What is the company doing to take advantage? How does the company see itself in the future? All of that has to be outlined. Now, one more thing you have to keep in mind here is, if a company gives out all the details, then the competition may also be aware of, and the competition may also be take advantage of that information. So without impacting its competitive position, how does the company wants to implement its strategy? How is the future looking like? What does the management feel about the future? All of that has to be disclosed. So an integrated report should provide an insight into organization strategy and how it relates to the organization's ability. So what is the strategy? What is the ability? What is the linkage between two? Ability means what can the organization do? Say for example, a company has a strategy of low pricing. Okay, they want to capture market by offering low pricing. Does the company have the ability to achieve that strategy? So these kind of discussions should happen. And how does these two create value over short term, medium term and long term? So some parts which can be highlighted, some parts which can be included as a part of this is highlighting the risk, opportunities and dependencies flowing from the organization's market position and business model. So what is the business model? What is the business of the company? What are the risks? What are the opportunities? What are the dependencies? All of that can be explained. Then what is the view of those charged with governance about the relationship between past and future performance and the factor that can change that relationship? Generally by way of management discussion and analysis, director's report and all of that, they can explain what is their view about what happened in the past, what was the performance in the past and what is the performance in the future. Then how the organization balances short term, medium term and long term interest. How the organization has learned from the past experiences in determining future strategic directions. So overall, you talk about what is the strategy, what is the ability, what is the linkage between these two, what will happen in the future, how was the past performance, how will be the future performance, what have they learned in the past, what are the opportunities they are seeing, what are the risks they are seeing, all of that has to be discussed here. Let's now have a look at a sample for integrated reporting. Now here it talks about, the company talks about building natural achievements and social capital. ABC's vision of sustainable and inclusive growth has led to the adoption of triple bottom line approach that simultaneously builds economic, social and environmental capital. Now when we talk about triple bottom line, see, first bottom line is your P&L, that is your financial bottom line. When we say bottom line, we generally mean profit. When we say triple bottom line, we are not only talking about economic, that is profit, also social and environmental part of it, right? Its social investment programs including social forestry, so they are talking about initiatives they have taken, soil and moisture conservation, sustainable agriculture, livestock development, biodiversity, women empowerment, education, skill, health and sanitation have had a transformational impact on rural India. So they are talking about what is the impact on rural India based on the company's initiative. Then these programs strive to empower stakeholder communities to conserve, manage and augment their natural resources, create sustainable on and off farm livelihood sources and improve social infrastructure in rural areas. Again, they are empowering the stakeholders to conserve whatever is the natural resources they can conserve and have on and off farm livelihood sources. So not only dependent on farming, outside farming what all they can earn. Through its business and associated value chains, ABC has supported the generation of around 6 million livelihoods, touching the lives of many living at the margins in rural India. So basically a lot of focus on rural area, a lot of focus on people who do not have resources and trying to uplift them. In line with its commitment to environmental goals, ABC has constantly strived to reduce the impact of its business, processes, products and services and create a positive footprint. ABC has adopted a low carbon growth strategy. So low carbon, so this part talks about society. Low carbon growth strategy through reduction in specific energy consumption and enhancing use of renewable energy sources. Now you would have been following news where there is a lot of talk around reducing carbon footprint, being net positive in terms of carbon footprint and all of that. So here the idea is to use more renewable sources which is environmental friendly and ensure that the carbon footprint is lower. ABC also endeavors to reduce specific water consumption and augment rainwater harvesting activities both on-site and off-site at watershed catchment areas, as well as minimize waste generation, maximize reuse, recycling and use external post-consumer waste as raw material in its unit. So again about water conservation, use rainwater harvesting, not to waste water, right? Reuse, recycle and all of that. So this basically contributes towards environment. So here the company is talking about their strategy for uplifting or for conserving environment and society. What are they doing towards environment as well as the society? The next principle is about connectivity of information. There is a lot of information in an integrated annual report, right? It would run into hundreds of pages, 400 pages, 500 pages. There's so much of information given, there has to be interconnectivity. There has to be connection between what the company is talking about. There has to be connection between what is the company's vision, mission, strategy, what is their business model, what is the financial information, what are the various capitals, what is the management judgment about the past, present and the future. There is a lot of other information which is available in public. All of these must be interconnected, they must be interlinked, and it must be presented in a format which is easily understood by even a common shareholder or a common stakeholder. So we'll have a look at this sample report extract which is given in the study material, of course. So it is about a company which is Sheephole Group company. Now here they are presenting their mission. We aim to rank among the world's leading airport companies. So that is the mission, very clear. We create sustainable value for our stakeholders by developing airport cities and by positioning Amsterdam Airport Schiphol as Europe's preferred airport. So they want to make this particular airport as the Europe's preferred airport. Schiphol ranks among the most efficient transport hubs for air, rail, road connection and offers its visitors and the businesses located at Schiphol the services they require 24 hours a day, 7 days a week. So that is their mission. What is the company profile? Company's profile. The company is an airport operator focusing particularly on airport cities. A prime example of an airport city is Amsterdam Airport Schiphol, Europe's 5th largest airport in terms of passengers and 3rd largest in terms of cargo. In addition to a Dutch operation, the Hague Airport, Indigolearn Airport and Lelystad Airport, ignore the names, just about the presentation. We have direct and indirect operations in the United States, Australia, Italy, Indonesia, Aruba and Sweden. Okay. Then activities. What are the various activities? The operation of the airport and development of airport cities involve 3 intricately linked business areas: aviation for flight, consumers, the passengers and the real estate. So when you talk about airport city, basically there is an airport and in and around the airport there are some commercial areas, there could be hotels, there could be meeting areas and all of that, where flyers would come, they would have meetings there and then they would fly back. Okay, so it's a wholesome city in itself. The concept is not only applied to Amsterdam Airport but also either in part or in full to other airports, particularly through alliances and participations business area. Our revenues derived from this broad range of activities are made up for the most part of airport charges, concession fees, parking fees, retail sales, rent, leases, etc. Okay, so that is basically talking about their operation. Then strategy. The maintenance and reinforcement of the main port's competitive position and that of Amsterdam Airport Schiphol in particular is the single most important objective on which our strategy is focused. The strategy combines the airport's socio-economic function with our entrepreneurial business operation. The interconnection and interaction between these two elements are crucial for robust and future-proof development of Schiphol Group going forward. So basically what they are saying is, the maintenance and reinforcement of the main port's competitive position, it has to be competitive, and that of Amsterdam Airport Schiphol in particular. So they want to place it as the most competitive, most preferred airport. Corporate responsibility is an integral part of this strategy and has been permeatingly increasingly all aspects of our operation. Then stakeholders, talking about stakeholders, who all are their stakeholders, has many stakeholders and they conduct an active dialogue with all the stakeholders. Our core value plays a key role: reliability, efficiency, hospitality, inspiration and sustainability. Achieving the ambition to be Europe's preferred airport calls for a culture driven by a desire to fulfill or better yet surpass the expectation of the customer and local stakeholders. So basically there are many stakeholders, they continuously engage, they want to exceed the expectations of the stakeholder. Now one thing for this report is, because it is extracted from a foreign company's integrated report, the language seems slightly fancy. Okay. Right. Now what we'll do is we'll also have a look at the Tata Motors integrated report. So here if you see, the integrated report as it starts, they have talked about what is the report. We'll give it a pass. So see, about the company profile, the presence, the portfolio, performance review, basically the message from the chairman, the executive directors, CEOs and all of that, performance highlights, what are the various business segments, how they create value, sustainability review, the board report, business responsibility report, report on corporate governance, then the financial statement and notice of AGM. 496 pager report is this, right? Then as we move forward, you see what is the company about, what is the company profile. Okay, they basically explain the profile, their values, right? and a performance snapshot, Jaguar Land Rover, Tata Motors and all of that. They have mentioned about that. Then global presence, they speak about that. Then what are their product offerings, various kind of products which they offer in commercial vehicle segment and also passenger vehicle segment, right. Then about Jaguar Land Rover. Then about management, what does the management feel like, what is their communication, in that they talk about their products, their challenges and all of that. Then I will just skip slightly further. Then the key performance highlights, electric vehicles are the thing that is happening currently, so discussion about that. Then the commercial vehicles financial metrics, operations, and here if you see challenges faced and their response, and again challenges faced, response, what are the various capitals which are impacted, even that is being mentioned or discussed here. So basically that is a linkage. Strategic review, so what is their overall strategic review and how do they want to develop the market, expand into new opportunities and all of that. New business update, whatever has happened in the new business update. Then overall operating context. See, everywhere you see the capital is impacted, financial capital is impacted, manufactured capital is impacted. What kind of capital is impacted? So here if you see, this is social and relationship capital. So they are linking each aspect of their operations to various capitals which are being impacted. Then the overall strategic review. For JLR again the same thing. So like this, it's a lot of discussion, okay. If you read it for the first time, especially when you're not working elsewhere, you might find it boring. But I strongly suggest, take one annual report and read it end to end. Even if it takes an entire year, please read it end to end. It gives you a lot of perspective about businesses, how they do and how they function, right. So that is about the second principle. Let's now move on to the third one. The third principle is stakeholder relationship. Now every company has multiple stakeholders, shareholders, creditors, bankers, local society, government, employees, suppliers, customers, right. All of these are stakeholders. So the company needs to identify its stakeholders and it must respond to their needs. Now what are the needs of stakeholders? Investors want return on capital, employees want salary, society wants better product, right, government want taxes, customers want good quality product, suppliers want on time payment. All of these needs are there. So the company should identify the stakeholder needs and the company must address the stakeholder needs. The company must respond to the stakeholder needs, right. So that is about stakeholder relationship and management. Then the next principle is materiality. Now this materiality principle we learn in financial reporting also. Here also it is equally applicable, because if you start explaining each and every bit of the business, it becomes really a lengthy report. So what the organization has to do or what the company has to do is, it needs to identify various area. It needs to rank them in terms of the relevance, okay. So which area or which component is most relevant in terms of value creation. Accordingly, in that order, it should identify and disclose them in the annual report based on the materiality. So basically when we talk about materiality, only those matter which substantially contribute to the value creation, whether over short term, medium term or long term, that has to be disclosed. Each and every item need not be disclosed. Then the next principle is about conciseness. Now when I say conciseness, there is, I just showed you a report which runs into 500 pages, even that is concise, because Tata Motors as a company which I have taken as an example, it's a huge company, right? So many businesses, joint ventures, subsidiaries, right? So many dealers, operations and all of that. For that company, that is still a concise report. So it has to be concise. Why it has to be concise? Because each and every minute information may not be necessary and you don't need to explain in detail about lot of activities which do not add value to the end stakeholder. Same principle also applies to your exams. You should write quality answers and not lengthy and poor quality answers. If the answer is qualitative, then even in a single page you can score 5 marks. If the answer does not have quality, even if you write 4 pages, you will not score marks, right? So when we talk about integrated reporting, we should ensure that it is concise and it is not very lengthy. Now, how can we make a report concise? By applying materiality principles. So we can apply the materiality determination process and only present those matters which are material. Don't present anything and everything. Then you can have a logical structure and have cross references to limit repetition. So a lot of time what happens is there could be same thing which has to be presented at multiple places, right? So you can have cross reference. For example, things related to ratios. Now that ratios you would have calculated at a particular place. Those ratios can be linked to the integrated report and say, okay, for these ratios you can refer to this and this particular page or this particular section. Then it may have linked to more detailed information or to information that does not change frequently or to external sources. Now there could be something which has been presented in a concise manner in the report, But the management feels that, for some users, they may want to know more details. Give a link. Using that link, they can go to the website and they can see, okay, what is the detail about that particular item. Or there could be some items which do not change frequently. Regarding that, you can have a separate static report to which you can have a linkage to. Or there could be some information from external sources like the overall, growth scenario, economic scenario and all of that. For that also, you can have a link given in the report. That will make the report concise. Then, explain the concepts clearly in as few words as possible. This applies to your exam also. Okay, no need to use any fancy jargons. Use simple language as much as possible so that the other person can also understand. Favor plain language over the use of jargon or highly technical terminology. As I told you, use as simple words as possible and avoid highly generic disclosures, often referred to as boilerplate, that are not specific to the organization. So avoid making general statements, general disclosures about the industry, about the government, about the economy, about the overall world economic growth, unless it is material to your organization. Don't make general disclosures, right? So these are the principles for achieving conciseness. Then the next principle is reliability and completeness. So it must be reliable, it must have all the material matters, and it should not be containing any kind of material error. It must be reliable and it must also be complete in all aspects. And consistency and comparability. So again here, the way you present information in an integrated report must be consistent over a period of time, and it must be comparable with previous period reports and also with that of the industry, right? That is why we have this IR framework. Now, having understood the principle, let's have a look at the content which has been suggested by the IR framework as to how should the integrated report look like and what all should be the content of that particular report. See, there is no standard format, but at minimum, these are the items which has to be disclosed, and it talks about 8 content elements. So basically, you should describe these 8 things very clearly. What are they? First one is organizational overview and external environment. So basically, what is the organization all about? What does the organization do? And what is its external environment? External environment, as you would have learned in strategic management, the political, economic, social, technological, legal, all that external environment, and what is the organization, right? So here, what is the question you are trying to answer? You are trying to answer the question which is, what does the organization do and what are the circumstances under which it operates? So what does the organization do? What are its mission? What is its dream? What is its vision? What is the strategy? And what are the circumstances, the external environment, right? So here, in the organizational overview, you report the organization's culture, ethics and value, ownership and operating structure, who owns what portion of the company, principal activities and market, what are its principal business activities and what are its principal markets, competitive landscape and market positioning. So what is the competitive landscape, who are the competitors, what is its market positioning, what is its market share, and position within the value chain. In the overall value chain, what is its position? Then you can also give some quantitative information like number of employees. You can give the breakup of employees. We saw in the annual report the breakup of employees, full-time, part-time, senior management and all of that. Then revenue, you can add profitabilities and all of that. Number of countries in which it operates, significant changes from prior period. Then significant factors affecting the external environment and the organization's response. What all is happening in the external environment, what are the risks, what are the opportunities, and what is our response. That is a overview of the organization. Then in the external environment, you talk about legal environment, commercial, social, environmental, political. Basically, the pestle framework can be used. And how does organization create value in light of the external environment, in light of risk, opportunities, and how does it create value over the short term, medium term and long term. That is the first element. The second element is governance. Now please understand, there is something called governance, there is something called management, right? So management is responsible for achieving the objectives and goals. Governance is responsible for overseeing the management, whether management is doing its work properly or not, whether the strategy is being achieved or not, whether ethics is being followed or not, laws and regulation compliance, all of that is taken care by governance. So you have something called as management and those charged with governance. So when you look at a company, those charged with governance would be generally your board of directors, the independent directors, the audit committee, all of that. And when it comes to the management, you would have executive directors who would actually implement the strategy, and achieve the organization's goal. Now here we are trying to answer, how does the organization's governance structure support its ability to create value in the short, medium and long term? So the question you are answering is, how does the organization's governance structure, what is the governance structure in the organization and how does it support the value creation over short, medium and long term? Now here you talk about the leadership structure, leadership structure, like so how many directors, how many executive, how many non-executive, how many independent, right? Then what are the skills, what are the qualification, experience, right? All of that you explain. So you talk about the structure, the background, the gender, competence and experience of those charged with governance, and whether regulatory requirements influence the design of the governance structure. So has it been set up because of some legal requirement? For example, Companies Act have a requirement that there must be so many independent directors in some specified company. You must have an audit committee. So is it because of the statute, or the company on its own has created the governance structure? Specific processes used to make strategic decision and to establish and monitor the culture of the organization, including its attitude to risk and mechanism for addressing integrity and ethical issues. So here you are talking about how do you address risk, how do you handle ethical issues, how are strategies formulated, right? All of these you will try to explain broadly. Then particular actions those charged with governance have taken to influence and monitor the strategic direction of the organization and its approach to risk management. So have they taken any specific action, have they taken any specific decision to take care of the organization's strategic direction? Then how is the organization culture, ethics and values are reflected in its use of the capitals and effect on the capital, including its relationship with key stakeholder. So how does the organizational culture, what is the culture, the value, the ethical system, right? What is the impact of that on the various capitals? How is that impacting the communication with stakeholders, relationship with stakeholders? That is what you will disclose. Then whether the organization is implementing governance practices that exceed the legal requirements. So do we have governance practices over and above the legal requirements, right? That is another part. Then responsibility those charged with governance take for promoting and enabling innovation. So how much does TCWG, that is those charged with governance, they encourage or they promote innovation. Then how remuneration and incentives are linked to value creation in the short, medium and long term, including how they are linked to the organization's use of and effect on the capital. So again, when you remunerate someone, especially the senior management level, when you see, or even at the employee level, how much do you remunerate or give incentive for innovation? Somebody coming with a brilliant idea, a nice innovation, do you remunerate them? Do you incentivize them? That is what you have to discuss. Actually, these are just generic disclosures, and management has to take a call as to how much of this is relevant for the users. Then moving on to the third one, business model. What is the business model? We have understood about business model in Ind AS as well, right? So here you are trying to answer what is the organization's business model. So basically, what are the inputs, the business activities, outputs and the outcomes. Inputs in terms of various capitals. What is the business activity? What do they do? What are the various outputs and what is the various outcome? Output is the final product or service. Outcome is the end result, right? So output could be in terms of quality products. End result could be you are enhancing your social relationship, right? So that is what is covered in business model. Then various risks and opportunities. What are the specific risks and opportunities that affect the organization's ability to create value over the short term, medium term and long term, and how is the organization dealing with them? So basically, what are the risks which have been identified, what are the opportunities which have been identified, and how does the organization manage risk, how does the organization take advantage of the opportunities. Then strategy and resource allocation. So here what they are trying to do is, where does the organization want to go, the vision, and how does it intend to get there, the mission part of it, right? So it basically talks about the short, medium and long term strategic objectives, the strategies it has in place to achieve those objectives. So basically, what are the objectives, what are the strategy for achieving those objectives, resource allocation to implement the strategy, and how it will measure achievements and target outcomes for the short, medium and long term. So basically, what is the strategic objective, what is the strategy to achieve that objective, how will you deploy resources, what kind of resources are needed, and how will you measure the success over the short, medium and long term. Then performance. Now performance can be both financial performance and non-financial performance. To what extent has the organization achieved its strategic objectives for the period, and what are its outcomes in terms of effect on the capital? So now in the previous thing it was about what are the objectives. Now it is about how much has been achieved and what are the outcomes and the effect on the capital. If you remember, in the annual report we saw some outcomes and impact on the specific capitals, like maintaining, enhancing equality, women empowerment, right? All those are outcomes, and what is the objective, whether it has been achieved or not, that needs to be described. So here it contains both qualitative and quantitative information that may include matters such as, so it can have quantitative indicators with respect to targets, risk and opportunities, explaining their significance, implications and the methods and assumptions used in compiling them. So, what are the quantitative indicators in terms of the targets, the risk, the opportunities and what is their significance. Then, organizations affect both positive and negative on the capital, including material effects on capital up and down the value chain. So, what is the organization effect on the various capitals, right? That has to be disclosed. The state of key stakeholder relationship and how the organization has responded to key stakeholders' legitimate needs and interests. So, what are the key stakeholders' needs and interests, how they have been addressed, that has to be disclosed. And the linkage between past and current performance, between current performance and the organization's outlook. So, what is the past performance, current performance and how does this relate to the future outlook of the company. Then, general outlook. Here you are trying to talk about what are the challenges and uncertainties the organization is likely to encounter in pursuing its strategy and what are the potential implications for its business model and future performance. So, basically what are the challenges, what are the uncertainties and what will be the impact on the future performance, that is what is being discussed here. So, here you talk about the organization is expected about the external environment and the organization is likely to face in the short, medium and long term, how that will affect the organization and how the organization is currently equipped to respond to the critical challenges and uncertainties that are likely to arise. So, basically what are the expectations, what will happen in the external environment, how will it respond to the challenges, whether it has the ability to respond to the challenges, that is what is being disclosed here. Then what is the basis of preparation and presentation? So, how does the organization determine what matters to include in the integrated report and how are such matters quantified or evaluated? Basically, what is the basis of preparation and presentation? How do you determine what are items are material? Generally, companies would refer to the integrated reporting framework, right? So, integrated reports describes what is the organization's materiality determination process, how they have determined materiality, what is the reporting boundary and how it has been determined. So, how they have determined the reporting boundaries and the significant frameworks and methods used to quantify or evaluate material matters. So, what is the framework used? What is the method used? Basically, most of the companies would be using the integrated reporting framework, right? So, these are the content elements which must be present in an integrated report. Now, as far as examination is concerned, you might just be bogged down with so much of content, right? So, I don't expect that you will get a 20-mark question to list down all of this. So, basically, if at all you get a question, it would be some 5 to 6 marks of question where you must be able to explain each of these, basically, right from beginning. The content element, the first one being organizational overview and external environment. So, what it means, what it broadly includes. You must be able to describe in briefly, okay. Then about governance, what it means, what does it include, right. So, like this, for each of the content element, you must be able to describe. So, just to summarize, what are the 8 content elements? The first one is organizational overview and its external environment. The second one is governance. The third one talks about the business model. The fourth one talks about the risk and opportunities, basically, so what are the risks and opportunities. Then the fifth one talks about strategy and resource allocation. The sixth one talks about performance. The seventh one talks about outlook and the eighth one talks about what is the basis of preparation and presentation of the integrated reporting, right. So, remember these 8 points with a brief explanation of each of these points. Now, apart from this, there are also some general guidelines about integrated reporting. The first one is disclosure of material matters. So, only the material matters must be disclosed. We have already understood the meaning of materiality. Material matters must be disclosed. How is the materiality determined? That has to be disclosed, right. You should only disclose those matters which are significant in relation to value creation. The second one is disclosure about capitals. So, we have talked about 6 capitals, all of those capitals must be disclosed. Then the next part is aggregation and disaggregation. So, at what level should the data be aggregated and presented? That should be decided by the management depending on the utility to the stakeholders, right. Should you give too much of details or should you give aggregated and summarized information? The management has to take a call. And then the time frame, right. So, what is short term, what is medium term, what is long term? It depends on company to company, industry to industry. So, again, this has to be properly defined while preparing the integrated report. Let's now quickly have a look at the differences between the traditional or current way of reporting and integrated reporting, right. Now, if you talk about current reporting, a lot of that has already transitioned into integrated reporting, but if you look at the traditional way of reporting and the integrated reporting, what are the differences? Now, first one, if you look at the focus, traditional reporting is more focused on past data, whereas integrated reporting is more focused on the futuristic data. If you look at the time frame, the traditional reporting is more focused on short term, whereas integrated reporting is focused on short, medium and long term. If you look at traditional reporting, it is more rule based. If you look at integrated reporting, it is principle based. And if you look at the manner in which the reporting is done, traditional reporting is paper based. In fact, even today you have to physically take a printout and sign the annual financial statements, right? Of course, some of that is being digitized, but if you look at the integrated reporting, it is more technology based, the way it is presented. Then when you look at the details, the traditional reporting is long and complex. The integrated reporting is more concise and it is being simplified, or the approach is a simplified and concise approach. Then when you look at the thinking or the approach, traditional reporting is more in silos. Silos means it is only looking at one specific angle, whereas integrated reporting is integrated. We are not looking at silos. Silos means standalone or independent cylinder. Integrated means they are linked to one another. And lastly, if you look at the stewardship, basically means responsibly managing something. Traditional reporting focuses only on financial capital, whereas integrated reporting focuses on not only the financial capital but a total of 6 capitals. Right, with this we come to the conclusion of integrated reporting. Slightly theoretical and boring, but then very, very important when you especially look at sustainable development goals. Right, now as far as exams are concerned, from this particular chapter, learn about the capitals, learn about the various principles, learn about the contents, the general guidelines, right? So if you learn all of these and also these differences that we have discussed just now, if you learn all of these, then it would be more than enough for an examination point of view. I don't expect more than 5 to 6 marks question from this particular chapter, right? And read few more annual reports which will give you an idea of what integrated reporting actually is. Now just to give you a perspective, International Accounting Standards Board, IASB, they are looking at integrated reporting pretty seriously, right? So they are trying to widen their reporting framework to include the principles of integrated reporting, and also SEBI has asked companies to voluntarily comply with the integrated reporting framework, right? Especially with the listed companies, and that is where we saw the integrated annual report of Tata Motors, right, which has the integrated reporting framework.